Two longtime friends start investing in rental properties together. It goes great for years until one of them goes through a divorce. Suddenly, the ex-spouse now has legal claim to part of the properties. The partner never saw it coming. Today, we're going to discuss what can go wrong if you own property together.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just insights to help you stop guessing and start planning your financial future.
Welcome to a Wiser Retirement Podcast. I'm Senior Financial Advisor Shauna Theriault, and today I'm joined by estate planning attorney Arun Gupta.
Hi, Shauna.
Good morning.
Good morning.
How are you?
I'm doing great. How about you?
Doing wonderful. Today, we're back together. We always talk about all these things with estate planning. It's one of my favorite subjects, hopefully one of yours too,
Yeah,
I assume.
Yes.
Or else you're in the wrong career.
Well, I guess it has to be at this point.
Might as well since you're so good at it, right? So today we're going to talk about owning together and what could go wrong, like owning properties, owning real properties, owning businesses and all of those things, and then titling of assets and all that fun stuff and what could go wrong. We see this all the time, right?
Yes.
We looked up this stat and we were talking about it before the show started, that property is the number one cause of inheritance disputes, that 51% of inheritance disputes are about land or property and not about cash.
Yeah. And I would that makes a whole lot of sense to me, because the problems that I see are generally, this is the one type of asset that there's so much more involved than just a dollar value.
Right. Which
cash,
that could be a problem too.
Yes,
like
it
valuing.
can. Yes, of course.
Splitting it. What, like, we're going to go through like so many different, problems with that land or property. And I guess that could be businesses too, which, I don't know how much you see that, but certainly real property and houses and stuff.
Yes.
So we'll go through all that. It's just interesting. We were talking about different things and, before, and we'll go through some hiccups that you've seen and I've seen and just ways to avoid that. But, just why people own assets together. Obviously, married couples buying homes, friends or siblings investing property, parents adding children to accounts, business partners investing together. There's so many ways that we don't think about each day why people own assets together and the problems it can cause. Yeah. So remind me, and I don't mean to, in Georgia or in a state, is it automatically, if you're married filing or joint tenants rights of survivorship when you own a property with a tenant?
So if we're talking about real estate,
right?
You have to. There has to be something in the deed that alludes to survivorship. If you own property with somebody else, if you own property with your spouse, the default, absent any survivorship language, would be tenants in common. And that's not always the case in every state. Sometimes it's presumed, if you're a married couple, that it would have survivorship provisions. But it's always good practice if you're married and you intend to own real estate as with survivorship provisions, that should be in there. Now, that's not always the case with another type of asset, financial assets, right?
Yeah.
The default in those situations is not going to be tenants in common.
Right.
It is going to be, if you die, the surviving account holder is going to own the entire account. Yes, that's generally how it works. Now, you can still have an account with somebody else as tenants in common, but in my practice, usually it's almost always the default for that would be survivorship. But with real estate, you have to be
careful.
Yes,
because it really depends on the state and the deed wording. I've seen that.
Yes.
It's like you really have to go look at it.
Yes,
and we'll get into the different types of ownership, what they mean generally as a short education in here, but just generally from, why people owning assets together from a financial perspective, like we're talking about married couples buying homes together, owning property together. Sometimes, friends or siblings, they will invest in property together, say, okay, let's go in and buy this, beach property or this condo on the beach together because it's cheaper. We'll do it together where you can both take on, the expenses of that, and then we can both share it, and then, all of that. So we've seen that a lot. One of the hard things we'll get into later is parents adding children to accounts. Sometimes for convenience or avoiding probate. There's nuances to that we need to get into. And then, obviously business partners investing together. And so really, from what you see, I would think in estate planning perspective, like I said, joint ownership is to ease of probate, and passing property is probably what you see. A lot of times they'll, maybe parents adding kids to deeds or accounts, which there's a lot of problems with that. And we'll talk about it. Family properties like vacation homes. Where else do you see people adding?
It's usually the most common I see is when someone adds someone to they want to add someone to the deed to their home, or they want to add someone on a financial account so that other person can just do it for them. There are other better means to do that, because that creates issues, unintended consequences.
Exactly.
Basically, you add someone to an account that's your child, you may be disinheriting your other child, especially if most of your assets are tied to that one account. That's what I see a lot. And then a lot of these joint ownerships, it's not always by choice. Someone died and left property to people, and now they own it jointly. They probably don't want to, but they can't figure out what they want to do. So, that it happens a lot too. And that's where things can kind of get tied up for a while.
Yeah. Well, let's talk about that. So, there's the common problems we're talking about. I really, I want to talk about, what you've seen and what I've seen, what we've seen together just in problems with this. The first one being, you alluded to it. Let's just talk about, I think you and I've just talked about it before, but I can't stress this enough. Like adding your kids to your accounts and your house.
Yes. So first off, for the financial account, commonly people will, especially maybe an elderly parent that has one of their children that just is around more, that helps take care of them more.
Yeah.
It's just easier if I add you to the account. Well, it's not difficult to add someone to an account, but it's also not difficult to name that person as your financial power of attorney. That way they can do the thing that you want them to do, which is manage your assets for you, take care of your financial matters, sign on your behalf so you don't have to. But that doesn't create an ownership interest in the person that you're adding to that account. So, if you have a $1 million account and you add a child to it, and your intention is to leave everything equally to your two children, and most of your assets are tied up in that, $1 million account, and you die, that the surviving account holder, the child, is going to have $1 million. And then they may think, oh, well, they'll just deal with it later. They can even things out. Well, they can even things out. And then there's a tax hit that they're going to have to go through. And it just creates a lot of unintended consequences, stress, headache, paperwork, you name it.
Yeah. I want to talk about that. So let's say you have a brokerage account that's worth $1 million. And you add your son to this account. You have a son and a daughter, and you're doing that so your son can help you with the finances. Issues. Number one, that's a gift.
Yeah.
Most people don't claim it, and it's fine. It's technically that's a gift. But even if that doesn't go unnoticed, now dad passes away, and now son inherits that $1 million. 100%.
Yep.
He does not have to give any to his sister. Correct?
Doesn't have to.
Doesn't have to. Legally, he
Yeah.
can keep that money and go. And I've seen that actually happen.
Yes.
I have seen that happen where you think, oh, you're going to help, and they don't. And and this is deep, but I do like to point this out because people do this with the house. People do this with property. When you have a joint account and one person passes away, half of the account gets a step up in cost basis. So let's say the cost basis, let's say it's all Apple stock. I'm just making it up. And the Apple stock cost basis is 10,000 and it's worth $1 million now. There's, 990,000 unrealized gain. If the one person passes away, only half gets a step up in cost basis. Whereas if it was just owned by the dad, son was power of attorney, it doesn't automatically go to son, and the whole account gets stepped up to the million, but now only half of it does. That's a problem.
Yeah, I see it all the
You
time.
just you did not save taxes.
No, especially it hurts when you see someone that did it a long time ago.
Yeah.
Because immediately I'm thinking there's already a gain right here, and this person that is going to inherit it when you die, the entire thing, they already have half of it.
Right.
They already have it.
Right.
So then when they turn around and want to sell it, they're going to have to
they're going
to have it.
When you could have just put it in your name and power of attorney and left the beneficiary, or through the will,
Yeah.
proper means. And then, so let's say the son, let's keep playing this out. Let's say the son decides, because he does have the decision,
Mm-hmm.
to either gift half to his sister or not.
Mm-hmm.
Let's say he goes ahead and does, because now it's gifting.
Yep.
Well, there's a $19,000 annual exclusion.
If he does it all in 1 year, well,
Right.
then even
Technically, he's supposed to file a gift tax return.
and if he doesn't, maybe there's not a tax owed if you use part of your lifetime exemption. Well, if you don't, technically there's a 40% tax on anything that's over the annual limit, which right now is $19,000. Now, the enforcement of these, if you give a $20,000 gift to somebody, is the IRS going to come after you for the $1,000 over the annual exemption? Probably not, but that's not a game you want to play. And when you get higher and higher in value, then it's really not a game that you want to play.
No, definitely. I mean, if you were trying to do things right,
Yes.
that's a messy way to do it.
Yes.
I've seen it with houses before, the same problem, bank accounts, all of that. And even if it's just $100,000 bank account or whatever, technically they don't have to pass it through the rest of the family. And now there's just these issues of gifting, and it leaves it very unclear. So, with that, I would do the power of attorney and leave your beneficiaries proper.
Yeah, exactly. If the issue is I want to give this to this person so they can better manage it for me, no, don't put them on the title. If they're going to get it when you die, don't put them on the title. If that is your intention. Now, it could be different if they're using it for something. There may be another purpose, but absent that, convenience is not the reason to do it.
Absolutely. Other things about common problems, let's say, let's say I had a situation where the two brothers, parents died.
Mm-hmm.
One brother was living in the house.
Uh-huh.
And, because his parents had moved, they let brother move in with his wife and children living in the house. So parents eventually passed away. And there's two brothers.
Mm-hmm.
This house goes 50-50 to the two brothers. Well, it's very messy because you have the brother that's living in it, doesn't have the money to buy out the other brother and give him his half. So let's say the house is worth $300,000. Technically, brother living there is supposed to give brother not $150,000, but he doesn't have liquidity to do that.
Yes.
So now you have a situation where, the one who doesn't have the home is faced with, having to either kick his brother out, have this conversation, all these things. It's like, what do you do in that situation? It's like, what do you do? It's like, I mean, you hope your brother does the right thing and says, hey, let me try to get a loan or do whatever. That whole thing is just very messy.
No, it is. And there's, again, especially when it's with siblings, because everything is so loaded. There's emotion involved. You want to do the right thing, but the right thing, no matter what, is going to hurt somebody.
Yeah.
And it's tough to deal with. And, taking care of all of this on the front end is always worth it. If there was something in writing that said how this is supposed to be dealt with, it's just going to make life easier.
Yeah.
And in a way, it kind of takes out am I doing the right thing? Am I not? Because you're following what the document tells you to do. You can almost just use that as an excuse.
Yeah.
Sometimes, listen, that's why I did it. And it's true, that should be the reason why you do something, because you have to do it that way. And, you brought up liquidity. That's a huge issue, especially when it comes to real estate. It's tied in this property. And if you got to pay up sometimes, right? And it might force a sale. It might put everybody in a situation where they may, otherwise they may not have wanted to be in it. And when you let something drag out, then it really adds up, foregone rent, all kinds of things that make it even harder.
It's just a hard family situation, but
Yes.
things to think about if you're the parent and you're in that situation, you know, you have to kind of think, okay, what happens if I
Uh-huh.
pass away and my one son is living here and the other one doesn't have this? And, maybe it's like, hey, maybe you decide to leave him the whole house and you equalize it by giving him other assets. So
Uh-huh.
it's not, you know what I mean? So
Yep.
it's like, well, and it's up to the parent really.
Yep.
And some parents are like, well, I'm not here. It's not my problem. Most are not that way though. So it's like if you think about your one son living here and your other son is not, and the dynamics there, maybe you change the way the estate is flowing and you leave the house to the one son and these other assets here
Yes.
just to make it simpler so that it's not,
Yes.
confrontational or what have you.
You're talking about this. I've got a client right now. She owns property in another state with 4 of her other siblings. Inherited it after their parents passed away. It's been going on for 8 years. They don't know what to do with the property. They just don't know what to do. It's been deeded out of the estate into each of their names. And my client's the one that kind of handles everything. And it's been such a headache for her that she's making sure, when I die, this is going to my kids, but I'm making an exact plan. If you can't decide what is going to happen within 120 days, then this happens.
Mm-hmm.
And that's it.
Mm-hmm.
You're going to sell it if you can't agree to buy the other one out or but the decision is not going to drag out for 8 years. You're going to have to do what this document says, and that's it.
Right.
And she's speaking from life experience. She's dealt with so much stress and headache. It's not worth it. It's not worth it.
Yeah.
And a little bit of foresight can, instead of just punting, sometimes it's better to just be clear and make the decision for your kids.
Yeah. Yeah. I think that's fair. That's definitely fair.
Before we go back to the episode, did you just finalize a divorce or know someone who has? Download our post-divorce financial planning checklist, a free guide from Wiser Wealth Management. It covers everything from updating accounts to building your new financial future. Visit wiserinvestor.com/guides to get your free copy. All right, let's get back to the episode.
Another thing we see all the time, thinking about like divorce too. Let's say, a couple goes in and buys a beach property or like a condo with another couple, it's like, okay, the two couples, we're going to go buy this beach property and go in together and we're going to, share the expense and share, going there and all these things, and we'll rent it out and we're going to be partners in this, in this one property. Well, then maybe one of the couples gets divorced.
Yeah. And then,
it's so messy.
Oh no, it's messy.
Because it's like you had this friendship that, one is like, sometimes it's weird because it's like, who are you still friends with? Because sometimes it's all like that dynamic of you don't agree with whatever, and maybe you're still friends with one and not the other. But now you're trying to negotiate half of the property in a divorce proceeding.
Yep.
And still maybe have rental income and dealing with all of the expenses, and somebody doesn't want to pay. That could just be really messy.
Oh yeah, it's so much more than, it's not just picking sides of who you're going to go to dinner with now. No, it is they need to settle their divorce, and this is property. Now, when did you purchase it? Is it marital property? What happens if one of the spouses needs the liquidity? Then they're going to come to you, and maybe they're trying to force a sale, and you didn't want to sell.
Yeah.
And then all of a sudden, beyond the emotions involved in it, you may have to pick a side because it's in your financial interest to pick a side, and then things just get way messier, and then you just get mad at everybody.
Yeah.
Why do you have to get divorced? Now you're making my life harder.
Oh.
And that happens all the time. And again, when you brought this up in my head, I'm thinking you can put the property in an LLC.
Yeah.
You can have an operating agreement that
it should be an LLC if it's a rental anyway, and it's with people that are not, married and all that.
And you have to address those 3 important questions. What happens when someone wants out? What happens if someone gets divorced? What happens when someone dies? Those 3 things have an answer for.
Yeah.
It doesn't have to be that complicated, but those 3 questions you should have an answer for.
Yeah.
Because those things happen a lot. One, you're going to die. There's 40-50% chance that you get divorced. And I don't know if you want out, I'm guessing over a 10-20 year period, you're going to want out at some point.
Well, you could even be in a situation too. Remember, like, let's say you bought it with siblings or something, and it's like one sibling. We've all seen this, and it's like maybe they lose their job or they come into some financial issues and they can't, and then there's a problem with the condo or the whatever, and we have to do a repair or we have to pay somebody, and they don't have the money to do it.
No,
and they're supposed to pay half, but what are you going to do? Like, go after your brother or your sister for the half? And so then you're like, I have to do this, and so now you're paying. Like, that's messy too.
But you feel like you should because you're the eldest, or this is just they're in a bad spot. No, of course, yes, but it's hard. No matter what, there is a negative emotion, stress that is unnecessary if you can put it on paper beforehand. And that doesn't necessarily mean there's not going to be problems afterwards.
Sure.
But at least you have direction.
Right.
At least there's a roadmap to resolving this.
Yeah. It's really just thinking about, in beforehand, how are we going to handle if these situations arise?
Yes. Yes.
And going in with your eyes wide open and having a plan to handle if something like that happens.
Yes.
The other thing, going through different type of joint ownership types. So we kind of started on that. And so this is something that many don't know about. So there's really, joint tenants with rights of survivorship. There's tenants in common. Some have community property states too. We're not in Georgia, but there are some community property. But really the main two are joint tenants with rights of survivorship and tenants in common.
Yes. And that essentially means if you own something with survivorship provisions with somebody else, the ownership interest is going to default to the surviving account holders at the original account holder or the first account holder's death. Tenants in common would mean at that person's death, whatever their interest is going to be distributed pursuant to either what the terms of their will, trust, some sort of governing document will say. So that's big picture wise. That's the general distinction between those.
Yeah. So basically, if you have two individuals, if it's two individuals that own a property 50-50, joint tenants with rights of survivorship, if one dies, it passes automatically to the surviving tenant.
Yes.
If you have tenants in common, and this is usually like if you're doing siblings or you're doing, somebody that you're not married to necessarily.
Yes.
And sometimes on the deeds, even if you are married, if it doesn't say with rights of survivorship, it's kind of tenants in common, right? Joint tenancy.
Yes.
And so that matters.
Yes.
So you want to check your accounts and your deed, because your deed is that's more of a gray. I mean, it's not automatic. Like you have to make sure that's in there.
I feel terrible for clients that, the deeds from, the 1981, you can barely even read it. And it just doesn't have that
tenant,
the survivorship language in there. And this may not even be discovered until 10 years after the first spouse died, because then when the second spouse is maybe nearing death, and maybe they didn't have to probate any of the first, when the first spouse died, because everything they thought was just joint and just passed to the other one. And then they discover, well, when I die, that 50% that was owned by the first spouse, that there's a cloud there. And the only way that that's going to be handled is by then probating
the first
spouse's estate. And it's more to deal with when you can update your deed.
You can just look at it and see what it says.
Or have a professional look at it and guide you and tell you this is what it says and this is what my recommendation is. Sometimes it's as simple as, John and Jane are transferring their interests from John and Jane as tenants in common to John and Jane as joint tenants with right of survivorship.
Yeah.
And that's it.
Nothing else. Is that just a form?
That's a deed. It's a deed.
Form.
You're quit claim deeding it, and that's it. You're just changing.
It's so simple.
It's very
Saves
simple.
all that.
Thousands of dollars.
But the tenants in common is like, okay, if one of them passes, their portion goes via their will or however their estate is set up.
Yes, that's right.
Now, it may go back to the spouse, but you may have a situation where you have siblings or friends, which if you have a rental property, you should probably do an LLC. But I see it all the time where you're like, to your point, the woman that your, client you currently have, she has 4 siblings or 3 siblings. It's the 4 of them. And she wants her portion to go to her kids.
Yes.
So if it was joint tenants with rights of survivorship, then they would just pass to the
Correct.
surviving tenants
Correct.
versus tenants in common.
Yes.
It would go to her heirs
Yes.
based
Yes.
on her will.
Yes.
So
That's
that
right.
is the differential there.
Yes. And, a lot of my clients use revocable trusts as their main estate planning vehicle. Maybe a client, or maybe a person owns a home with their child, and it's with survivorship provisions, but they don't want to deal with probate for the rest of their assets too. And so, we create a trust for them, and then we make sure that everything is titled to the trust. Well, if I deed that property, the 50% from the client's name to the revocable trust, it's going to break the survivorship provisions on the
Yes.
deed automatically.
Okay.
So if she dies, okay, if her intention was it should go to the child that's already on the deed, then we need to be clear about that in the trust, because otherwise it just becomes part of everything else. And that may not be an intention.
Got
where
it.
you may think, I own this with somebody else, I'm just changing it from myself to my trust. Well, if you do that, then the survivorship provision is broken.
Because you
basically.
can't have an individual in a trust to have a survivor.
Basically,
'cause
yes,
it's not a person.
Yes, it's considered, even though it's
Interesting. I
it's
did not
even-
know that. See, you
even
teach me something new every
even
day.
though a revocable trust is considered an extension of the person, and
Correct.
it's taxed at their social security number, and it's not a separate entity for the IRS.
It
for
is.
purposes of deeds. It would be. Now, I'm
Interesting.
sure that there is some argument that has been made that, and it's gone up there, but generally speaking, on the surface, it's gonna break the survivorship.
Interesting. I
Yes.
did not know that. That's
Yes.
so interesting.
Yes.
So the titling matters, and you should definitely look at your deed to
Yes.
see how it is. And if you want it to go to the survivor, whoever that is, I mean, sometimes you want it to go to the survivor.
Oh,
but
yeah.
I still think the whole step up in cost basis needs to be addressed, because let's say in that situation where you have the two brothers and you're like, okay, well, I want it to go to them, so I'm just going to put it in their name now. Well, then, they're losing the step up in cost basis. There's nuances to that, and gifting, the cost basis stays with it. So really the better thing is to just leave that whole property in your will to them.
Generally speaking, yes. If the intention is that that you want them to have the use of it, title wise, basically when you die, it's better for them to inherit it when you die, so that if they don't want it later, that their theoretical, capital gains hit is just going to be lower.
Yeah.
It's now,
But I guess we have to think about liability too. It's like, okay, but they're living in the house. So there's just so many things to
Yes.
consider, which
Again,
we would talk about. But
yes,
for
putting in
purposes
writing,
of,
yes,
yes.
is if you think that there is a dilemma or a question that you have as to how something could be handled, it's almost always a signal that, hey, we'll just get this in writing. We'll take care of it.
Right.
We can address any other questions that we have about this too when we get this issue taken care of.
And
you
really
can always
talk to-
amend this. You
Yeah.
can change this
Yeah.
in the future. You're not locked into an operating agreement. You
Yeah.
can change the terms of it if something happens.
Yeah.
But it is a good idea. Again, those when someone wants out, when someone dies, when someone gets divorced, those things happen too much for those to just be in the air,
Right.
or for it to kind of be thrown on one person.
Yeah, I mean, just all of that. If there's any question to, how is it taxed, what the estate plan is, if you're sitting here going, how, thinking forward, how does this play out? I definitely think getting with your advisor, finding an advisor, talking to an estate planning
Mhm.
attorney, and thinking through the taxes. What does the estate plan look like? What happens if we get a divorce? What is the liquidity? And have an investment strategy, or have a strategy to handle it in all those situations, and communicate it with the heirs.
Sure.
Even.
And there are probably people listening out there that maybe they're getting a little scared of, I didn't take care of this. I don't know what my documents say. Well, guess what? If you talk to someone, I will meet with clients and I'll look at everything. They're in good shape. This has been addressed. They just don't know that it's been addressed because life happens and it's been decades.
Yeah.
But hey, you actually have provisions that address all of these very issues, and that's a good thing to know.
Yeah.
It's peace of mind. And so if you have a question about it, you can, you may be pleasantly surprised with the answer of, hey, we did take care of this already.
Yeah.
This is addressed. My deed's in good shape. I don't have to do this complicated thing. I don't have to do a new operating agreement. There's provisions in there that says what will happen.
Basically, we've started talking about that. How do we do this correctly? Putting agreements in place.
Yes.
You can do things like when you're in business or you're in, rental properties, having an operating agreement like
Yep.
you talked about for the LLC, property co-ownership agreement. I don't know if you ever do those or not. I guess it's just having in writing, obviously with the LLC
Yes.
and all of
Almost
that.
anytime that almost all of the clients that I have that own, I'm going to use an LLC as the vehicle to do it
Right.
because you're already adding that liability protection. But it doesn't have to be
Yeah.
through a formal entity. It could be two people own the property. How are they? It's a contract, right?
Right.
But again, have it in writing.
Yeah. And definitely cover who's going to pay the expenses,
Yes.
what happens if somebody wants out,
Yep.
How to resolve disputes and all of that. You can do buy-sell agreements. You can use, life insurance to help with some of this. A lot of times that's used when, you have businesses where, because that's a whole nother. Yeah. It's like, what if you have, business partners and, then you get divorced or pass away and then the spouse steps in and they're part of the partner. Right.
And
So that should be definitely dealt with, transferring or structuring a business with other partners. And how do you handle that situation? If you pass away or get divorced, is your spouse going to then step in as you and then be partners with everyone? So from what I've seen, I feel like a lot of businesses address that, but some of the smaller businesses may not.
most of the ones that don't address it, in my experience.
Yeah.
Because a lot of times, obviously, if the person dies, the business is essentially over,
Yeah.
right? And if that's not the intention, or if there's some sort of workaround, then all of a sudden, a spouse who doesn't know what they're doing, and they're not, in that industry, maybe it'd be better served if they had appointed somebody else, maybe to kind of handle that.
Yeah.
But again, putting something in place is going to be the answer to almost all of the issues that we're talking about.
Absolutely.
And it doesn't have to be some fancy formal thing, right? If you write down on a sheet of paper some of the things that you want addressed, you're already making progress.
Yeah. Yeah. Just like we talked about, and just in summary, before you start ownership of an asset, ask the questions. What if somebody wants out? What if somebody dies? What if we get divorced? How do we want to handle it? And then, really just starting that discussion, not when you're looking at houses or what have you, but, during that whole process, and understanding if you're going to be partners with someone, and they're uncomfortable conversations sometimes, but it has to be played out because it's going to be more uncomfortable later, I assure you, with the stuff we've seen.
Yes. Have the conversation that you have before you actually own it is going to be so much better than we're in it. Now what?
Yeah.
Guaranteed.
Yeah.
Guaranteed.
And I mean, people usually have the best of intentions, but when, things happen and emotions happen or finances happen or life situations arise, we do the best we can at the time, but sometimes your hands are tied.
No one goes into a marriage thinking they're going to get divorced, right?
No.
You just have to plan for these situations.
Absolutely. Absolutely. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. See you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.